The Federal Reserve is coming for stablecoins. This has all been revealed in a Fed report that alleges stablecoins are a risk to the financial system and implies that they're unregistered securities that need to be regulated. Today, we're going to break down this report and tell you exactly what it could mean for the crypto market. So, if you hold any crypto, what's in this video cannot be missed. The report we'll be summarizing today is titled, quote, "Runs and Flights to Safety. Are Stablecoins the New Money Market Funds?" It was published by the New York branch of the Fed, which apparently does good research, last month. We'll leave a link to the full report in the description if you're interested. Now, the report begins with a brief introduction wherein the authors explain what stablecoins and money market funds are. If you're watching this video, well, chances are that you know what a stablecoin is. What you may not know is that most stablecoins are backed by US government debt. This makes stablecoins akin to money market funds, which are also backed by US government debt. Money market funds are also designed to be pegged to a dollar. The difference is that money market funds share some of the yield on their reserves with their holders. A TradFi stablecoin with yield, if you will. This means that stablecoins and money market funds are vulnerable to runs, that is, everyone asking for their money at the same time. This forces stablecoin issuers and money market funds to sell their reserves, which can result in them not having enough money to meet withdrawals if they have to sell those reserves at a loss. Being unable to honor all customer withdrawals at the same time causes the value of stablecoins and money market funds to fall below their dollar pegs. For stablecoins, this is called a Depeg. For money market funds, this is called breaking the buck, and it's only happened twice, in 2008 and March 2020. Now, of course, stablecoins have depegged on multiple occasions, and the authors highlight two: the collapse of Terra's UST stablecoin in May 2022 and the depeg of Circle's USDC in March this year. If you watched our video about the USDC depeg, you'll know it actually wasn't Circle's fault. To refresh your memory, Silicon Valley Bank collapsed after it experienced a bank run. USDC depegged after Circle revealed that it held a large portion of its cash reserves at SVB. After SVB got bailed out, Circle got that cash back, and USDC subsequently repegged. Again, not crypto's fault, TradFi's fault. On that note, you should know that a large portion of the stablecoins in circulation are technically backed by money held in money market funds. According to Tether's most recent reserve attestation, more than 10% of the USDT in circulation is backed by money sitting in money market funds. And, according to Circle's transparency page, over 90% of the USDC in circulation is backed by money held in the Circle Reserve Fund, a money market fund managed by asset manager BlackRock. If you watched our video about the debt ceiling being raised, you'll know all the debt issuance by the US Treasury Department could cause instability in money market funds. Logically, this could create risks to stablecoins by extension. Oddly enough, this is something the authors of the report do not mention. Coincidentally, though, the report itself is about the similarities of stablecoins depegging and money market funds breaking the buck. This is more significant than you think. Money market funds are securities regulated by the SEC. Drawing parallels with stablecoins, therefore, invites regulatory scrutiny. We'll come back to all of this later on, though. Anyways, in the second part of the report, the authors give some additional background info about stablecoins and money market funds. They highlight the fact that the total market cap of stablecoins has skyrocketed over the last 4 years, from $5 billion in 2019 to over $125 billion in April this year. They explain that there are two categories of stablecoin: those that are based in the United States and those that are based elsewhere, aka offshore. And within these categories, there are 3 subcategories of stablecoins: those backed by traditional assets, those backed by crypto, and algorithmic stablecoins. Again, if you're watching this video, then chances are you know about each of these crypto categories and types. What you may not know, however, is that a whopping 96% of the total stablecoin market cap is made up of stablecoins backed by traditional assets, which you'll recall is mostly US debt. Another thing you might not know is that only a handful of entities can mint and redeem stablecoins, with issuers like Tether and Circle. The overwhelming majority of stablecoin users must buy and sell stablecoins on the secondary market, such as on cryptocurrency exchanges. Speaking of which, you should know that you can get trading fee discounts of up to 60% on the best crypto exchanges over on the Coin Bureau deals page. The link to that will be down in the description. Now, what's funny is that the authors refer to precious metals such as gold as risk assets in the context of reserves. This is funny because central banks around the world have been accumulating gold at record levels over the last year. You'll know this if you watched our video comparing gold and Bitcoin. What's nice is that the report's authors explain how most of the stablecoin types work in detail in the appendix. What's not so nice is that they refer to DAOs, like MakerDAO, as companies, implying that their tokens are securities. Well, at least they didn't go out of their way to bash these stablecoin niches like other reports have done. Now, regarding money market funds, the authors start by underscoring something mentioned a few moments ago. They are regulated by the SEC, and the report literally says they are, quote, like stablecoins. And like stablecoins, money market funds have grown to $5 trillion, up almost 2x over the last 10 years. As you can see, though, some types of money market funds have grown faster than others. The dark blue is for money market funds backed by US government debt. The light blue is for those backed by private assets, and the green is for tax-exempt money market funds. Not surprisingly, it's the smallest category. What is surprising, though, is just how much the money market funds backed by US government debt have grown. Their assets under management are up about 5x over the last 10 years, and they account for most of the money in money market funds. Later on, the authors explain this was due to SEC regulations. Regardless, the authors then switch to looking at the similarities and differences between money market funds. There's not too much worth pointing out here beyond what I already mentioned. The authors seem to imply that money market funds are better because they're bought by institutional investors. They also compare the reserves of money market funds and stablecoins. Notice how BUSD and USDP have similar reserve compositions to money market funds. This similar composition could be a part of why the SEC targeted Paxos over its issuance of BUSD. Note, though, that the details of the scrutiny are unknown. Anyhow, the authors go on to analyse the run risk of money market funds. They explain that during times of crisis, investors will typically switch their money out of the riskier money market funds into the less risky ones. As you might have guessed, that means switching from private assets to US government debt. As such, it was actually the money market funds backed by private assets which broke the buck back in 2008 and March 2020. Meanwhile, the money market funds backed by US government debt saw massive inflows, as you can see here. It's possible that we'll see the same phenomenon during the next crisis. And this ties into the third part of the report, and that's the data. Interestingly, the authors used data from CoinGecko for their analysis. This is interesting because they probably would have gotten a more accurate reading if they used on-chain data. It's the Fed, after all. Surely they have access to this type of data. In any case, the authors examined stablecoin flows and pegs during two events: the collapse of Terra's UST in May 2022 and the depegging of Circle's USDC in March of this year. Obviously, the authors included data from the months just before and just after to get the full story. Not only that, but the authors analysed almost every stablecoin you can think of. They even analysed the value of stablecoins being staked on 10 different blockchains. They did this using DeFi Llama, so I suppose that counts as on-chain analysis. You can learn more about on-chain analysis in the description, by the way. I digress. Now, in the fourth part of the report, the authors do a detailed analysis of the data points I just discussed. First, they analysed how stablecoins behaved during periods of stress in the crypto market. For reference, periods of stress mean the days that Bitcoin's BTC saw abnormally large losses. Naturally, during periods of stress in the crypto market, algorithmic and crypto-backed stablecoins experience large outflows, while offshore stablecoins see smaller outflows. Conversely, onshore stablecoins, those based in the US, remember, experience inflows, signalling a flight to quality. Second, the authors analysed how stablecoins behaved when Terra's UST collapsed last May. Lo and behold, it was the same story, but to the extreme. Algorithmic, crypto-backed, and offshore stablecoins saw enormous outflows, with onshore stablecoins experiencing enormous inflows. Third, the authors analysed how stablecoins behaved when Circle's USDC depegged this March. The first infographic here is seriously concerning. It's almost certainly meant to imply that any banks serving stablecoin issuers are unsafe. Note that banks serving stablecoin issuers are facing scrutiny as you watch this video. More about that in the description. Moving on. Now, what's strange is that the authors claim that there was no change in flows when USDC depegged, even though their own infographic shows otherwise. You can clearly see that the market caps of USDT and TUSD increased significantly after the depeg, with BUSD and USDC continuing to fall for months. What's stranger is that the authors admit that there was a change in flows when USDC depegged just a few sentences later. What's annoying is that they don't explain why this happened. Now, far be it for us to do the Fed's work for them, but it's because US-based stablecoins are at high risk of a regulatory crackdown. Anywho, by this point, you're probably wondering why the authors wanted to analyse stablecoin flows on blockchains. The answer is because they wanted to see if there was a similar phenomenon seen during depegs as during break-the-buck events, namely, people moving money within the same institution. The authors found what you'd expect. On bigger blockchains, the stablecoin flows are exactly as noted above, moving from algorithmic and crypto-backed to onshore stablecoins, in the case of the Terra collapse, or from onshore stablecoins to offshore stablecoins, in the case of the USDC depeg. On smaller blockchains, however, the inflows and outflows are the same, regardless of the stablecoin type. In other words, crypto holders perceive smaller blockchains to be inherently riskier during times of stress in the crypto market, even more so than stablecoin issuers, apparently. Another fascinating finding is the threshold at which stablecoin holders start to panic. Based on the available data, the authors determined that stablecoin holders start to panic when a stablecoin falls to 99 cents. In their opinion, this is what counts as an official stablecoin depeg. The fascinating thing here in this case is that a 99-cent depeg only results in outflows of around 3%, which, don't get me wrong, is quite a bit when you're dealing with a stablecoin worth tens of billions. The thing is that the authors found no increased outflows for further depegs down to 98.5 cents. To put things into perspective, a fraction of a percent is considered breaking the buck for a money market fund and enough to cause massive flows. As such, you could say that stablecoin holders are less prone to panic than money market fund holders. In the author's opinion, they're just inexperienced. Now, in the conclusion, the authors reiterate that stablecoins perceived to be safe experience inflows during periods of stress in the crypto market. They also reiterate that stablecoins see outflows from blockchains perceived to be safe regardless of the perceived safety of the stablecoin in question. And then they put this as their final statement. Quote, "Should stablecoins continue to grow and become more interconnected with key financial markets, such as short-term funding markets, they could become a source of financial instability for the broader financial system." Typical Fed. So then, what does all of this mean for the crypto market? Well, the answer ultimately depends on what the purpose of this report was. From our perspective, its purpose was to throw the issue of stablecoin regulation into the SEC's jurisdiction. This requires a bit of backstory. So, if you've watched any of our videos about stablecoin regulations, you'll know that stablecoin issuers, particularly those based in the US, have been trying to classify themselves as payment stablecoins. That's because it would put them under the jurisdiction of the Federal Reserve, which regulates money. This is why Fed Chairman Jerome Powell's statement that the Fed sees stablecoins as a form of money was so significant. It seemed to confirm that the Fed sees stablecoins as being under its jurisdiction. The caveat there is that the Fed's regulation of stablecoins could be even more aggressive than the SEC's. What this report suggests, however, is that the Fed no longer wants to deal with stablecoins. It's quite possible that the reason for this pivot is what we alluded to in the intro: issues elsewhere in the financial system. Whatever the case, though, it's clear from our perspective that the hot potato has been passed. Writing a report that underscores the similarities between stablecoins and money market funds, and effectively claiming that stablecoins should be regulated by the SEC, seems to be more than circumstantial. It's also very important. For those unfamiliar, the New York Fed is very influential. If you want actual circumstantial evidence, look no further than Circle's recent move to throw its weight behind Binance in its case against the SEC. This is unprecedented considering Circle's USDC was, and technically still is, a competitor to BUSD, which the SEC alleges is a security in its Binance lawsuit. Circle jumping in to help defend Binance could therefore be evidence of the idea that the Fed has passed the baton to the SEC. Additional evidence can be found in the idea that Circle planned on becoming a national bank regulated by the Fed. These plans were recently scrapped due to regulatory changes. Now, assuming we're correct, then this means that the SEC could soon come knocking on the doors of US stablecoin issuers, and this is very likely if the SEC wins its case against Binance. The caveat in Circle's case is that asset managers like BlackRock have significant sway with regulators such as the SEC. In theory, this should protect Circle from undue scrutiny, but in practice, it might not be so clear-cut. Another thing we've noticed in our analysis of regulators like the SEC is that megabanks also have significant sway. The SEC actually seems to be struggling to satisfy both of these influential groups. Now, if megabanks get the upper hand, then it's safe to assume that the SEC will crack down on stablecoin issuers of all kinds. That's simply because there's over $100 billion of money backing stablecoins that the megabanks want back in their coffers, not in shadow banks or other assets. If BlackRock gets the other hand, though, then it's safe to assume that the SEC won't be cracking down on Circle. Recall that BlackRock manages most of USDC's reserves. It stands to lose tens of billions in the event of a crackdown. On the flip side, BlackRock could gain tens of billions if USDC's circulating supply increases. Come to think of it, the Fed's recent report confirms that if there was a disruption to offshore stablecoins, or even just a crypto market crisis of some kind, then onshore stablecoins like USDC stand to benefit. Some would say that this creates an incentive for Circle and BlackRock to make something like this happen. Others would say that BlackRock's spot Bitcoin ETF application offers an additional incentive because it's believed the SEC will only approve it once most of BTC's trading volume has come onshore. That means trading against stablecoins like USDC on exchanges like Coinbase, which has also partnered with BlackRock. Never mind that there's been lots of speculation about BlackRock wanting to buy BTC at a discount. Anyway, speculation aside, it's clear that the regulatory scrutiny of stablecoins is increasing again. Whether it's coming from the Fed or the SEC is arguably irrelevant. The only thing we can do is keep track of these developments and adjust accordingly. So, you can rest assured that we will continue to keep you fine folks informed and up to speed. And that's all for today's video. If you found it informative, smash that like button to let us know. If you want to stay informed, subscribe to the channel and ping that notification bell pronto. And if you want to inform others, take a second to share this video with them before you go. If you're looking to maximize your crypto gains or just keep your crypto safe, check out the Coin Bureau deals page. Remember that it has up to $40,000 in bonuses on the best crypto exchanges. It's also got the biggest discounts on the best hardware wallets. So the link to that will be in the description. Thank you all so much for watching, and I'll see you in the next one. This is Guy, signing off.